we, the members of Telangana and Andhra Pradesh Taxable Association, are very much happy for accepting our invitation for sharing the knowledge on the topic new ideas and are very much grateful. Thank you once again. President Ritesh Mittal, President welcome address. Over to you, Ritesh ji.
Sir, Ready, sir. First of all, I would like to thank our speaker, Ujjwal Jindal, for
Ritesh ji, over to you.
First of all, I would like, on behalf of Telangana Andhra Pradesh Taxable Association, I welcome all the members for this webinar on the new ITR forms. And I welcome our speaker, Ujjwal Jindal, all the way from Delhi. And he is the second time he is taking the session for us, sir. First time he has taken in the month of August. And members, as you all know that, this year the ITR forms have been notified, and last year we had seen a couple of extensions happening. But this time I don't see any extensions. There is no purpose. This time there are no COVID thing. And we cannot expect much of extensions in due date this year. And most probably this month will be the due date for filing of TDS return. Once the TDS returns are all filed, at amounts, everything will be reflected in 26 years. And then we can go ahead and start filing the income tax return. So this was the apt time to have this program on the ITR forms. And with this intention, we had this program, and we thank Ramdev Budraji to again organize and coordinate with the speaker. And he is not here in the login today. He's on travel. So, and this is the overall thing with this objective we are having this program. And I welcome you all once again for this program. Over to the Secretary, sir. Yes, sir. I think now I'll request our Avdesh Zaima, our GC member, to introduce our speaker.
Very good afternoon to all my dear friends. I welcome today's speaker, Sri Ujjwal Jindal, CA, CS and advocate. It gives me an immense opportunity to introduce, like a multifaceted person. He is a first-class commerce graduate from Delhi University, BCom, CS, CA. He is a law graduate. He has done IFT certified program from CFA Institute, Six Sigma Black Belt, and he is a co-founder at QJ and Company Chart Accountants. He is a content writer also at Taxman, CA Club India, Tax Guru, newsletters and journals. It's a great honor for all of us today to have such a smart and enthusiastic person with us today. Thank you. Thank you once again. Thank you, Ujjwal ji.
Welcome.
Continue.
Present his session. Over to you, sir.
Thank you so much, Ritesh ji, Reddy ji, and Dalmia ji for such wonderful introduction and such wonderful words. So we all have gathered here to discuss more about the new changes that have came in the ITR forms. Every year we are seeing multiple changes, multiple new provisions and amendments that are coming up in the ITR forms, which affect the ITR filing in totality. And every year there are now happening so much updates. Even the new income tax portal is now in place. And we see changes flowing in from the budget amendments and even from certain other amendments that have been time to time in place. We have seen a new form from the budget proposal that stays ITRU, that is the updated return concept that came in for the very first time, where a person can file the returns for back 2 years staying in the current financial year. So we'll discuss everything today in very much detail. I have prepared the presentation, and I guess I'll be able to complete that presentation within 1 to 1.5 hours. it can range up to that time. There are around 75 slides and we have covered each and every aspect. There is nothing that is left out in the ITR return forms. And moreover, I have also covered the analysis of those provisions, like how they have been brought in, why they have brought in the ITR forms, and what was the purpose for their getting into or finding a place in the ITR return forms. So taking much time, I'll start up the presenter now. Okay. So we have gathered today for the discussion on ITR forms, and they are for the financial year 2021 and 2022. That is the assessment year 22-23. These are a few of my details. You can take note of them. If there are any queries or you wish to reach to me, you can definitely contact me on this past the session. Can I continue?
Yes, sir. Yes, sir. I'll do one thing. I'll mute everyone and I'll block their options of unmuting them.
Sure. You can do
Yes.
that.
Yes, sir.
Okay. Okay, so talking about the scope and coverage, so we'll be covering up the analysis. We will analyze and understand the recent insertion or updations in the income tax return forms for the financial year 21-22, that is the AY 22-23. Then there would be a detailed analysis of the relevant provisions as well, that why the changes were brought in, what made like these changes to be incorporated in the ITR return forms, what was their purpose, what these provisions are actually. So we have covered everything, and key changes in reporting requirement, and if there be any, we'll be taking up the question answers if time remains. Okay, so not taking much time, I'll give a gist of what various ITR forms are in place that we have to file in for all of our clients basically, and even for ourselves. So first, talking about the basic form, that is the ITR 1. So ITR 1, we all know, is for individuals who are residents other than not ordinarily resident, having a total income of up to 50 lakh rupees, having income from salaries, one house property, other sources, be it interest or dividend, and agricultural income that only is up to 5,000 rupees. So it's not for individual who is a director in a company or has invested into unlisted equity shares, or in case where TDS has been deducted under section 194N, or if the income tax is deferred on ESOPs. Now, what is this income tax deferred on ESOP is, we'll discuss that in detail, because this is also an addition that has to be reported in the income tax return forms now. Next comes the ITR return form 2, that we call by the popular name of ITR 2. So ITR 2 is also for the individual, as well as we add up HUFs here. So not having income from PGBP. Just 2 lines we have for this particular form, but there is a lot of details that we need to know about ITR 2, and all these details are present in Rule 12 of the Income Tax Rules 1962. So I would ask all the professionals that they should before filing or starting of the filing with the ITR return form, they must go through the Rule 12 of the income tax return forms. It is very much relevant to all the ITR return forms. There are certain conditions, there are certain provisions that are contained, and they are very much in line, or they are very much important with respect to the ITR 2. So ITR 2, and next we will come to ITR 3, that is for individuals and HUF having income from PGBP, that is profits and gains of business and profession, and we'll have to read the Rule 12 along. So not much difference between ITR 2 and ITR 3, just not PGBP and having PGBP, but otherwise the reporting requirements vary. Coming to the fourth form that we talk about, ITR 4 or the SUGAM. So it's for the individuals, HUFs, firms, but not for LLPs. Being a resident, having a total income of INR 50 lakh and having income from business and profession, which is computed on a presumptive basis under section 44 AD, ADA, and AE, as we know. It's not for individuals who are either directors in a company or has invested in unlisted equity shares, or if income tax is deferred on ESOPs, or has an agricultural income of more than 5,000. So the income limit again for the agricultural sector has been kept up for 5,000 as was in ITR 1 form. Okay. Next comes the ITR 5. ITR 5 is meant for whatever is left out, and we know LLPs were left, even the partnership firms can file. ITR 5. So for persons other than individuals and HUFs and company, and persons filing form ITR 7. So basically for the trust or the charitable institutions or schools, NGOs. So for individual, HUF, company, person filing form ITR 7. These are the exclusions to ITR 5. This goes into a negative or an against language, and all others can file ITR 5. And who are they? They are basically the HUF or the partnership firms or the LLPs. Please see Rule 12 again. The reference of Rule 12 again is important in here. Then we come to ITR 6. ITR 6, as we all know, is for companies other than companies claiming exemption under Section 11. Rule 12 comes into picture even here. And then the last form we talk about is the ITR 7, and it says for persons including companies required to furnish return under Section 139 4A, 4B, 4C, 4D only. And here also Rule 12 is of primary importance. Now, this was a gist of what we are discussing today, because we are discussing online with parallel to all the ITR forms that are there in place. So we have to study in first. I just included this into reference. All of you, all of us are like professionals and working in line with it, and we know what the forms are meant for. But it is important. It was important for just a primary or a preliminary review that what these forms actually are, and then we'll be able to discuss everything in detail. Now, if I'm starting up with this discussion, so what I have done is there are many changes that are common to certain forms. Like there are changes that are there in the ITR form 1 also, 2 also, 3 also, 4 also. So I have dissected the entire discussion into a common channel panel, what I say. So the common channel goes like that all the changes that are common to this particular ITR forms have been clubbed into one. So whenever I am discussing any provisions, so that would flow evenly to all the ITRs that have been mentioned up. So like we are starting up with the very first provision that has been changed or that has been added or amended. So that talks basically regarding a common change to ITR 1, ITR 2, ITR 3 and ITR 4. Starting up our main discussion right now with the first change or update that talks about nature of employment for pensioners further categorized. So if we have noticed in the old ITR forms, in the drop down of nature of employment, an individual receiving pension had to choose the option basically pensioners. In the new ITR forms, you will see that many other options have also been incorporated for the purpose of pensioners. And what are they? So they'll talk about pensioners, central government or CG, pensioners, state government or SG, or pensioners, PSU, and all other pensioners. So basically a further categorization for the pensioners has been added, and you have to specifically ask all of your clients this time that which organization are they getting pension for in, be it a state government pension, be it a central government pension, be it a PSU pension, or be it any other type of pension. So this change has been evenly flown to ITR 1, 2, 3, 4, and you have to ask your clients to get this particular information also, because you have to select this particular option in the ITR return form this time. Moving to the next change that talks about relief under Section 89A from taxation on income from retire benefit account maintained in a notified country. So this is a major change that has came up. However, there are certain rules that are missing in this particular amendment right now. But why I have included this in this particular discussion, the reason being they have incorporated this particular option in the ITR return forms, and all the forms have this particular option. What is it? Let us understand first what are the provision or what is the background of this particular provision. So where a non-resident became a resident in India, like earlier he was a non-resident, but after that he became a resident, the amount of income in his foreign retirement benefit account is chargeable to tax in India on an accrual basis. So India follows an accrual receipt concept. However, in the world or like other countries, it's like cash basis or the receipt basis. However, some countries tax such an amount at the time of receipt. Due to a mismatch in the year of taxability of such income in retirement funds, the taxpayers, who are generally the non-residents who have permanently returned to India, face difficulties in availing of the FTC or the foreign tax credit in respect of the taxes paid outside India on such income. So basically what was happening is the person is coming from a foreign state to an Indian state, now becoming from a non-resident to a resident. All his money that is lying in the retirement benefit account outside India is getting taxed in India on a concept of accrual basis. And however, whenever he is giving or whenever that particular amount is getting matured in the foreign country, it is getting taxed at that particular financial year or calendar year that country follows. And in India, as soon as he becomes a resident on an accrual concept, that amount becomes taxable. So there is a mismatch basically of tax calculation. So in India, it's like the financial year in which the accrual basis applies, and in the foreign country, it is the calendar year in which he is actually receiving that particular amount. So there is a mismatch, and that is why the availment of foreign tax credit was an issue. So seeing to this, section 89A inserted with effect from the assessment year 22-23 removed the aforesaid difficulty by providing that the income of a specified person from a specified account shall be taxed in such manner and for such year as may be prescribed by the rules. And as I said in the beginning, that there has been no rules that have been notified yet. But we see a new tab in the ITR return forms. The new ITR return forms have amended Schedule S that talks about this scheduled salary, details of income from salary to disclose income from retirement benefit account made in a notified country under section 89A and income from retirement benefit account maintained in a country other than notified country in section 89A. The eligible taxpayer is allowed to claim a deduction of income claimed for relief from taxation on the application of section 89A. However, it is not at all clear how this deduction shall be computed. A similar disclosure would be made in the schedule other sources, income from other sources in respect of family pension, because there may be cases where the person is receiving a family pension after the death of that particular person. So even in that case, this particular schedule has been applied in, and you'll be able to see just as a schedule salary, this particular change like income from retirement benefit account and income from retirement benefit account were not maintained in a notified country in the schedule other sources as well. So this is change that is common to all the ITR return forms 1, 2, 3, 4, and you have to like gather particular information from your clients respectively with regard to this particular change. Next, we move to changes that are common to ITR return form 3 and ITR return form 4. Don't think that we have just covered everything that has changed in ITR 1 or ITR 2. So there are changes that will be clubbed in the other panel segment. Okay, so we are just moving one after the other, like the amendments have been clubbed up that are common to ITR 3 or ITR 4 or ITR 1, 2, 3, 4. So we'll cover each and everything in detail. Moving towards the common changes to ITR 3 and 4, we see a disclosure for new or alternate tax regime, or what we call the new tax regime, that was notified under section 115 BSE that came in from the previous financial year for the very first time. So the following disclosures are required in ITR 3 and 4 in respect of the new or the alternative tax regime of section 115 BSE. And what is that? Whether the assessee has opted for an alternate tax regime under section 115 BSE and filed form 10IE in the assessment year 21-22, that is the financial year 2021. So for filing of form 10IE was made very important, and even many of our clients, when we missed out filing of form 10IE, they even got notice at the time of return processing that you have not filed for form 10IE. And this form 10IE acknowledgement number would automatically whether the assessee has opted for an alternate tax regime. I'm getting an annotation request, so I have declined it once, but I guess somebody has again poured it in. So we'll share the slides later. Don't worry for the same. Okay, so I'm getting back to the discussion. Whether the assessee has opted for an alternate tax regime under section 115 BSE and filed form 10IE in AY 21-22. So you have to basically mention it as yes or no, and as soon as you press it yes, the acknowledgement number would auto populate in the return this time for return for the form 10IE in separately. Next, for the assessment year 22-23, the assessee has to choose from the following option with regard to the provision of section 115 BSE. And what are they? Whether you are following, whether you are opting in for the new or alternative tax regime that is notified under section 115 BSE. In this particular financial year, if you are opting in now, you have to select that. If you are not opting it even this year, so you have to select not opting. If you will continue to opt, like you have opted the same even in the previous year, and you are even in this particular financial year you are opting in for the same, so you'll select continue to opt. And if you were opting in the last previous year but you wish to opt out now, so you'll select opt out. So basically the return form has a a significant disclosure that is required with regard to the alternate tax regime. Earlier we see there were just two options, whether you wish to opt in for the new tax regime, yes or no. But now, because this is the second financial year that we are talking about, so there have been multiple options and they are all relevant. So if you wish to opt in now, you can do that. If you do not wish to opt in, then you can select not opting, just like you did the last year. If you want to continue, you can continue, because this option is this regime is like for every financial year separately. Once you have chosen the previous one, if the next financial year you are finding the older regime to be like giving more benefit to your particular client or to yourself, so you have to choose the older regime. So that particular absolutely depends upon you. Effect whatever disclosure you have given to your salary. If you are salaried and you have given the disclosure to your employer that whether you were want to move under the new regime or the old regime, you can anyway change that particular option when you finally file your return forms for your clients. So these particular options have to be disclosed in for all the ITR return form 3 and 4. Now moving towards changes that are common to ITR 2, ITR 3, ITR 5 and ITR 6. All the return forms majorly. So this is very important. Schedule FA, that is fixed assets, to be reported of foreign assets held and income earned during the calendar year ending 31st December. So this is a major change. They have created a, basically there was a miscalculation or confusion in the minds of all professionals as to what is accounting period is, what is calendar year, what is a previous year for the computation of this particular FA schedule. But now they have made things very much clear, and we are going to study even the background and what the changes have been in place for this particular financial year. Also, I have created two illustrations to better elaborate on whatever the newly enacted provisions have in place for us. So let us understand what the background was a little bit. So the ITR forms, except 1 and 4, applicable for the AY 22-23, require a resident taxpayer to disclose his foreign assets in Schedule FA. Reporting is even required if a taxpayer is beneficial owner of such foreign asset or has a financial interest in a particular foreign entity. Disclosure in Schedule FA of various foreign assets such as foreign depository account, immovable property, trust created outside India is required. The reporting requirement is mandatory only for taxpayers who is a resident in India. Schedule FA is not applicable to person who is not ordinary resident or is a non-resident, obviously. So Schedule FA in the old ITR return form required the reporting of foreign assets only if the person had held them at any time during the relevant accounting period. So this particular term of accounting period was nowhere defined in the Act. However, there were certain instructions that were issued by the CBDT for filing these ITR return form, and they had provided the meaning of the same. For example, in taking note from that particular guidelines that was issued, for the AY 21-22, that is the financial year 2021, the accounting period means from 1st January 2020 to 31st December 2020 in respect of foreign assets or account etc. held in those jurisdictions where the calendar year is adopted as a basis for closing of accounts and tax filings. So there they took a purview that in the jurisdiction where calendar year was followed, the accounting period would mean a period starting from 1st of January 2020 and ending on 31st of December 2020. Okay. The CBDT had clarified that a taxpayer shall be required to report foreign assets only if such assets have been held at any time during the previous year of India, as also during the relevant accounting period on the foreign tax territory or the foreign tax jurisdiction. For example, just to elaborate the things, in the example that I started just before, Mr. Rocky had acquired a flat in UAE, say suppose in January 21, and sold it in March 21. So whatever is happening in the calendar year. So that is in January 21 and sold off in March 21. For the previous year 21-22, the relevant accounting period would be first starting from 1st of January 2021 to 31st of March 2021. The transaction of purchase of flat falls in the relevant accounting period. Thus, Mr. Rocky is required to report such foreign asset in the ITR, although the same is not held in the previous year 21-22, because he has already sold that particular asset in March 21. Even then, as it is getting covered in the accounting period, so for the reporting has to be in line. Now, this was a confusion that was always existing because another or the foreign tax jurisdictions had different calendar year. Even they were following calendar year starting from July and ending on June. So there was no consistency, and that is why the accounting period reporting for separate countries was every time required, and there was no solution to it. However, the government this time came up with a particular amendment or a particular update for this. The new ITR return form has replaced the expression accounting period with calendar year ending on 31st December 21. So they have made very clear that from now it would be calendar year only for all the countries that are there across the globe. So this change implies that the assessee shall furnish the details of all foreign assets held between 1st of January 2021 and 31st of December 2021 in the returns to be filed for the assessment year 22-23, that is the financial year 21-22. So this is irrespective, as I said, of the fiscal year being followed by the foreign country. Like we know that Australia, Mauritius or Bangladesh follows it from July to June. Costa Rica, Thailand follows it from October to September. The reporting has to be made if the specified assets are held on 31st of December 21. So that has been made very clear, and all the miscalculations, misreporting, misunderstandings have been done away now. Let us make it like more clearer with one illustration that I have made. So this illustration says that the relevant previous year for this particular financial year or tax filing is 1st of April 2021 and ending on 31st of March 2022. The relevant calendar year being 1st of January and ending on 31st of December 2021, as we told as per the new update. So date of purchase of share of Apple Inc. or a flat. Say suppose a person has made this particular purchase and that was in 11th January 2021. So the question is the assessee required to furnish the details of foreign assets? Yes, because it falls in the relevant calendar year. So the assessee is required to furnish the details of Apple Inc. shares in the ITR applicable for AY 2022, even if he has not held the foreign asset in the relevant previous year. So previous year becomes April to March for the Indian landscape, but the calendar year concept would go on for the accounting period or calendar year, what we'd say. So on 11th January, if he was holding that, he has to make a particular disclosure in the schedule FA. Taking this in line, say suppose this particular asset was purchased now on 11th January 2022. Previously, we took the example to be 11th January 2021. So now, are we required to furnish the details of this particular asset in the ITR form? The answer is no. The reason being, again, it is not in the particular accounting period, and therefore the disclosure is not required. So the shares of Apple Inc. were acquired within the previous year, but after the end of the relevant calendar year. Thus, the assessee is not required to furnish the details of Apple Inc. in the ITR applicable for 22-23. However, the disclosure requirement for such investment would fall in the next financial year or next assessment year. So in 23-24, again, this would become the calendar year, and that is why the reporting would follow, and Apple Inc. shares purchase has to be disclosed in that particular return form. I guess this is very much clear. Moving towards next change, that is additional disclosures in schedule CG, that is the capital gains. So there has been like various changes that have been coming up in the schedule CG this time, and like the reporting is multifaceted, starting from like when was the asset purchased, the indexed cost to be different, the cost of improvement year wise has to be disclosed. So there are many changes. So let us start one by one. So new ITR forms require the following additional disclosures in the schedule CG. So I have made it separately. So date of purchase and sale of land or building. This has to be disclosed up now. So it has been made mandatory to furnish the date of purchase and date of sale of land or building if the income arising from transfer of immovable asset under the head of capital gains. This additional disclosure would help the tax authority to verify the eligibility and allowability of exemption under section 54, 54 EC and 54F of the income tax schedule. So basically, if we are talking about like whatever why this reporting has been made in place, so that is just for the purpose of the government only, so that they are able to evaluate whether the sections 54 deduction, 54 EC deduction or 54F deduction is basically allowable to that particular assessee or not. Second, we talk about country and zip code if the property is situated in a foreign country. So if there is a sale of property that is located in the foreign tax territory or a foreign country, so there the disclosures would flow with regard to the country and its zip code. So zip code has to be declared separately. Just give me a moment. Moving next. Sorry for this short break. The next change is with regard to the disclosure of FMV, or the fair market value of the capital asset, and consideration received in a slump sale transaction. So let me tell you the background first. The Finance Act has amended section 5450B to provide that in case of slump sale, the FMV of undertaking or division transfer shall be deemed as full value of the consideration received or accruing as a result of transfer of such capital asset. CBDT was empowered to prescribe the method of determining the FMV of such undertaking or division. In exercise of such power, CBDT has inserted a new rule, that is Rule 11 UAE. It provides the higher of the following of the date of some sale shall be deemed to as the full value of consideration. So this came with the Finance Act 2021, and because of that, now Rule 11 UAE is in place, which says that higher of the following shall be taken to be the date of slump sale shall be deemed to be the full value of its consideration. And what is it? The FMV of the capital assets transferred by way of slump sale, or FMV of the consideration received or accruing due to transfer by way of sale. And this computation has to be made in line following the Rule 11 UAE for the valuation. So that is what the reporting requirement is, and we have to get in line with the Rule 11 UAE for computing this particular fair market value. So this is again a disclosure that is required for with respect to the fair market value, that whether you are actually doing performing this particular transaction or transfer in a slump sale consideration as per the fair market value. Again, a benefit that the government is seeking from everyone, so that the transactions are getting on a parallel or a fair side. Year-wise detail of cost of improvement to land or building. So the assessee is required to give year-wise detail of the cost of improvement, if any, incurred on the land or building. We have seen in the previous return form, we used to put the entire cost of improvement like from the past years, and that to the indexed one. So now they have made it like for the separate years, you have to show that particular amounts, not as a accumulated one, and that too the separate to be the other one and separate to be the indexed one. So let us see the new ITR return form. Seek the following additional details. These are cost of improvement, year of improvement, and cost of improvement with indexation. So there are like three parts to it. So cost of improvement would be the total cost. Year of improvement would be that year in which that particular cost of improvement was incurred, and again indexation getting applied from that particular financial year to the financial year in which the asset is actually sold up. So this has to be disclosed separately. These details are required to be given year-wise if the SSA has incurred the cost of improvement in different financial year. If it's in one financial year, then you have to give the detail for just one financial year. However, if there's, because the improvement happens over time, so you have to disclose these particular details over a time period. Separate disclosure for cost of acquisition and indexed cost of acquisition. Just as in cost of improvement, you have to give a separate disclosure for the cost of improvement, the cost of acquisition, and where the cost of acquisition with indexation. So that is required. So this is basically common to both cost of improvement and cost of acquisition. Moving towards the next change, that is dividend income taxable under section 222E, that is deemed dividend, basically to be reported separately. So we see in all the ITR return forms that dividend income has to be declared up separately, and after the DDT has been abolished and new provisions have came up, so it has become primarily more important that these provisions should be disclosed. Just give me a moment, guys. I'll just get back to it. I'm time and again getting an important call, so let me just attend it for once, and I'll just come back in just one.
No problem, no problem.
I am so sorry, everyone. Actually, it was an important call. So we are quickly getting back to where were we?
Yes, sir.
Okay. So we were on deemed dividend. So we talk, there are certain dividend disclosures that are required separately this time for this particular financial year. And the dividend income is, we know that the taxable is under various provisions or various heads. And now as DDT has been abolished, so the entire burden of filing for the dividend income is on the shareholder or the assessee himself. So that is why government has made the disclosure separate this time, and deemed dividend provisions have been made separate. What is deemed dividend basically? So if any payment of loan by way of a loan or advance by a closely held company to its shareholder who is a beneficial owner of 10% or more equity share capital of the company, or to concern in which the shareholder has a substantial interest, is deemed to be dividend to the extent it is covered by the accumulated profits excluding capitalized profit. Basically, if you are giving loan to a shareholder and he is also a beneficial owner, now if to be a beneficial owner he has to hold 10% or more of the equity share capital of the company. So that amount that you have given by way of a loan or advance, that would be deemed to be dividend under section 222E. And by that 222E, this particular amount has to be disclosed separately under the income tax return form this time as dividend received under section 222E. Until last year, there was no separate disclosure of dividend income taxable under section 222E. Total amount of dividend received by a taxpayer during the financial year is always clubbed and reported in schedule OS. So this was happening for the like in the past returns every time. But the new return form seeks separate reporting of dividend income taxable under section 222E. At the end of the session, I'll show you how this particular amount is being bifurcated this time. It says dividend and dividend under section 222E. Okay, so this was a short change about dividend. Now we're moving towards changes that are common to ITR 2 and 3. Later we have seen common changes to ITR 1, 2, 3, 4, 3 and 4. So now it's turn for ITR 2 and 3. So in 2 and 3, what we see is reporting of interest accrued on PF to which no exemption is available. We have seen again in the budget session, new rules have been coming up for PF that they cannot deposit an amount that is exceeding so and so limit. So whatever it is, we have to make the reportings this time for interest in order to help the government to calculate where the exemption is available or where the exemption is not available. So the Finance Act 21 has amended section 1011 and 1012 to provide that no exemption shall be allowed in respect of interest income accruing during the previous year in the recognized and statutory provident fund to the extent it relates to the amount or the aggregate amount of the contribution made by the employee exceeding rupees 2,50,000 in any previous year on or after 1st of April 2021. So the total amount or the aggregate amount of deduction that has been made up or kept in has been not exceeding the contribution to the tune of 2,50,000. So if the contribution exceeds this particular amount, then the interest that is being accrued on that additional amount would get taxable. Otherwise, if we talk about the PF interest, it's completely tax free. We have worked on an EEE model, that is exempt, exempt, exempt. So where you file for this particular PF or you deposit amount in PF, that is exempt. The interest income that you are getting from the PF is also exempt. And at the maturity after like 13 years, if you are withdrawing up the amount from the PF or it is getting matured on retirement, that is also exempt. But if the contribution would exceed rupees 2,50,000 starting from 1st of April 2021, then the amount of interest would get taxable. So interest income accruing in respect of employees' contribution over 2,50,000 shall be taxable under the head income from other sources. However, if such person has contributed to a fund, there is no contribution by the employer, the limit of 2,50,000 shall be increased to 5 lakh. The method of computation of such interest income has been prescribed in Rule 9D. So basically, if they're 50-50%, usually the amounts are contributed equally by the employer and the employee. So we are talking about a scenario where the employer is not contributing, even only the employee is contributing. In that case, he can contribute up to an amount of 5 lakh rupees. And on that particular 5 lakh amount, if he's getting or receiving any interest, then there would be no separate taxability for that PF interest. However, if he is contributing and even his employer is contributing, the total conjoint limit for this contribution stands at 5 lakh. Okay. In the new ITR form, the schedule OS has been amended to incorporate the reporting requirement of such interest income. Again, we'll see the disclosure at the end of the session. New schedule for reporting tax deferred on ESOPs. We had a talk about this particular assertion back when I was discussing the ITR 1 and ITR 4. We have seen that there is a new schedule for what is basically tax deferment on ESOP is. So an employee can defer the payment or deduction of tax in respect of shares allotted under ESOPs by an eligible startup referred under section 80 IAC. The tax is paid or deducted in respect of such ESOPs within 14 days from the earliest of the following period. After the expiry of 48 months from the end of assessment year relevant to the financial year in which ESOPs were allotted, from the date of assessee ceases to be an employee of the organization or where he sells, obviously, from the date of sale of shares allotted under ESOPs. So whichever event is happening first, within 14 days, the taxability would arise. The part B of schedule TTI or the total tax liability, tax liability on total income in ITR forms of AY 2021-22, that is financial year 2021, the previous one, shows the disclosure of tax amount deferred in this respect. So that was already in place. Okay. But the new schedule, the new ITR form has inserted a schedule called tax deferred on ESOPs. The schedule seeks the following disclosure: amount of tax deferred in the ITR form filed previous year, date of sale of specified security and amount of tax attributable on such sale, date on which it ceased to be an employee of an organization, or amount of tax payable in the current assessment year. So basically, if we are seeing whatever these disclosures are in place, the government has made, so that are just for the purpose of tracing or tracking whether the particular amounts have been deposited well in time, whether disclosures are proper, whether in the previous return the deferment sought was genuine. So all these reasons have to be reported in, and based on that, the government would evaluate that whether you are following the right provision in full sense. As balance amount of tax deferred due to carried forward to the next assessment year. So you have to disclose even this, like you have declared that particular tax deferment in the previous year and you have carried forward it to the next assessment year, even that has to be reported separately. At the outer limitation period of 48 months from the end of the assessment year relevant to the financial year in which ESOPs of allotted is not yet over, the employee shall be liable to pay tax deferment in the assessment year 21-22 in the previous year 25-26. Okay, so that goes on the period of 48 months combined. The new schedule has been inserted to keep track of the amount of tax deferred by the employee and the year it should be taxed in. As I said, the tax payable in the current assessment year is exported in a new row introduced in Part B TTI, Computation of Total Tax Liability on Total Income. So the disclosures are vivid. The computation has been made much vivid this time, and the reporting flows parallel. Next, moving to the change which says mandatory to choose suitable option for residential status in India. So we have been, like, whenever we were filing ITR 2, 3, we were always seeing an option of like being what was our residential status during that particular financial year, and we always selected, like, we have been residing in India for 182 days, or we have been in India for 60 days in the past like 4 years, or whatever the status or the whatever the conditions were. But this time we see even more conditions that have been flowing up, and that is where they have made a bifurcation of a resident being ordinarily resident and not ordinarily resident. So that disclosure also flows in. So determining the residential status of an individual in India is quite a tedious task. You know, there are so much conditions that are flowing up in this section. The new ITR forms give a suitable description of different clauses due to which the residential status is to be determined. These options are self-explanatory. So I'll show you that at the end of the session in the return forms. So they are self-explanatory. They are too much in detail. So we'll discuss them. The SSC has to choose the relevant option in the support of a selection of a residential status. The following options are available for selection: a resident, an ordinary resident, resident but not ordinary resident, and final is non-resident. Okay, so you have to select out of these three. However, the conditions that are mentioned in, they have been given separately under the following categories. Okay, changes that are common to ITR 3, ITR 6, and I have also mentioned up ITR 5 but kept them in bracket due to some reason. So it's basically to ITR 3, so ITR 6. So we are talking about the business returns. Okay, what this change is actually adjustment of unabsorbed depreciation from WDV as on 1st of April 2020. So this change is basic to the new or the alternate tax regime, because there the benefit of unabsorbed depreciation carry forward was not given. So in assessing opting for section 115 BSC, is not eligible to set off the unabsorbed depreciation attributable to the additional depreciation. Such unabsorbed depreciation relating to additional depreciation which has not been given full effect shall be adjusted to the written down value of the block of assets as on 1st of April 2020 in the prescribed manner. Third proviso to the rule 5.1 provides that the WDV of the block as on 1st of April 2020 shall be increased by such depreciation not allowed to be set off. In the new ITR form, schedule DPM or depreciation on plant and machinery, which deals with depreciation on plant and machinery, has been amended. It provides that WDV of the block as on 1st of April 2020 shall be increased by the amount of unabsorbed depreciation pertaining to the additional depreciation which shall not be allowed because of the adjustment on account of section 115 BS. So there has been a particular schedule to get the amendment in place. So that will ensure that the reporting is in place and you are not availing for the unabsorbed depreciation if you have chosen the new or the alternate tax regime basically. Similar changes have been brought in schedule DPM of ITR 5, that is for the firms or this LLPs or the cooperative society. If a cooperative society has opted for the alternate tax regime under section 115 BAD. So the alternate tax regime also came in for the cooperative society and the same conditions flow with regard to the unabsorbed depreciation. They cannot claim the benefit of the same. And that is where schedule DPM has been inserted in the ITR 5 as well for this particular assertion. Moving towards changes that are common to ITR 2, ITR 3 and ITR 4 and ITR 5, sorry. So ITR 2 is for individual, ITR 3 is again for individual and ITR 5 is for firms or LLPs or cooperative society. So what are these changes? Limiting the rate of surcharge on dividend income. So the Finance Act abolished DDT and moved to traditional system of taxation where companies or mutual fund do not pay DDT and the shareholders are liable to pay tax on such income. As the dividend is taxable in the hand of the investor, the Finance Act and Taxation and Other Laws Act removed the enhanced surcharge on dividend income. Thus, in case of an individual AOP, BOI or AGP, including FPI and specified category of AIF, the surcharge on such dividend income shall be levied at the rate of just 10% if it exceeds rupees 50 lakh but does not exceed 1 crore and at the rate of 15% when it exceeds 1 crore. So the rate of surcharge have been limited on this particular dividend income. So it won't be higher even if your total income is getting more. The consequential change has been made in schedule part B TTI to the limit to the rate of surcharge on dividend income taxable under 115 AD and other dividend income. So basically they have limited the surcharge accruing because of this particular dividend income. If your dividend income is up to 50 lakh, is ranging between 50 lakh to 1 crore, then the surcharge would be 10% on that particular income. And if it's exceeding 1 crore, so then it would go on to 15%. So that was just a smaller change. Now we are moving to changes that are common to ITR 3 and 5. Now again the business ITRs. So one being of individual, one being of firms or LLPs. So what are they? Separate disclosures required income from units located in IFSC and Schedule AMT. So there are certain clients whose units are located in IFSC. So in Schedule AMT, there is a requirement. AMT is payable by a non-company assessee whose regular tax on total income is less than 18.5% of adjusted total income. It goes on the same principle of MAT for companies. So it is for, but the only difference of rates is that it is for non-companies. However, if an assessee is a unit in IFSC, that is International Financial Control Service Center, deriving income solely from convertible foreign exchange, the AMT rate shall be 9% and instead of 18.5%. So there have been various advantages and privileges that are given to the units that are located in IFSC by the government. And one such change is the reduced tax rates or the reduced AMT or MAT rates. So the new ITR form in Schedule AMT has sought separate disclosure of computation of adjusted total income under section 115 JC in respect of units located in IFSC and other units. So now the income from units located in IFSC shall be reported separately in the Schedule AMT for computing the adjusted total income and tax payable there. Again, the reason for this disclosure is that whether actually the IFSCs are availing for this particular benefit and no other person is getting benefit out of it and they are paying AMT at the rate of 18.5%. So that is why the disclosures is required. We see that like after discussing many of the changes that have came across, the disclosure requirement has increased. Not much, the computational part is just the same. However, there are certain things that you will have to ask your client this time before you get on the seat to file these ITR return forms. Moving towards ITR 5 and ITR 6, one for LLPs and companies and cooperative society and one for the companies, both the business entities basically. So additional disclosures, certain income exempt under section 10. So there are earlier no separate disclosures were required in case of incomes that were exempt under section 10, 23, FB, FBA, FC, FCA, FF, FF and 4D. So I know everybody would be asking me what these sections are for. So even I don't remember all, but I have made a list so that everybody can go through them. So basically the disclosure would be required in schedule EI, that is disclosure of schedules of exempt income. So FB talks about exemption to venture capital fund or venture capital company. FBA talks about investment fund. FC talks about exemption to business trust. FE talks about exemption to a wholly owned subsidiary of ADIA or sovereign wealth fund or pension fund. And FF talks about capital gain for transfer of shares of a company resident in India on account of relocation of offshore funds and exemption to specified funds. So these are all exemptions. Again, just the disclosure requirement is separate, and now you have to give the exemption requirements. You have to disclose these particular exemptions in the ITR return form, that is 5 and 6. So now we are moving to changes that are common to ITR 3, ITR 5, ITR 6. All business entities, one individual, one LLP, partnership firm, cooperative society and company. So disclosure in respect of SEP or significant economic presence. So this is a good point. Explanation 2A to section 911 provides that significant economic presence or SEP of a non-resident in India shall constitute a business connection in India. For this purpose, significant economic presence shall mean any transaction in respect of goods, services or property carried out by a non-resident with any person in India, including the provision of download of data or software in India, if the aggregate of payment arising from such transaction or transactions during the previous year exceeds rupees 2 crore. Systematic and continuous soliciting of business activities or engaged in interaction with 3 lakh users in India. In the new ITR forms, the non-resident has to confirm if there is an SEP in India or not. If there is an SEP, the above mentioned detail of transaction and users have to be provided in the ITR form. Again, SEP has been made a concept, so that was there with the explanation 2A. But what they have made in particular is that for now, for these particular 2 assertions, you have to make the disclosure. One is with regard to the size of the transaction. So if it exceeds rupees 2 crore, then the disclosure is required. Again, if the interaction is more than 3 lakh users, again, this particular disclosure is required. So it is all existing in ITR 3, 5 and 6. So many disclosures flowing in one after the other in the ITR return form this time. So more basically on the part of the professionals, I see that they have to seek in more information from their clients. And you know, when you ask any of your client for some or the other information, they get too much irritated. But we have to make things like good and as per the government statutory instruction. So we have to follow everything with a sense. Next change is exclusion of dividend income from schedule BP. So exactly, dividend income schedule has moved completely to other sources, and all the disclosure with regard to the dividend income, because there is a separate tax that is attached and the surcharge limit is also attached. So they have designed the return form this time like that all the disclosures or the details has to be like performed in the other sources schedule itself, so that the individual conditions can be applied separately to the dividend income. So schedule BP, that is computation of income from business or profession, provides for exclusion of certain income receipts which are credited to the P&L account but are taxable under other heads of income. The list exclude income receipts taxable under house property, capital gains, other sources, section 115 BBF, that is income from patent, and section 115 BBG, income from transfer of carbon credits. Okay, so in this case, what they have done is this particular thing has been, but just give me a second. The exclusion is with regard to all this. The list include income that is receipt that is taxable under in these particular heads, and from here it has moved directly to the other schedule. The new ITR forms add dividend in the list to exclude it from the schedule BP if it is credited to the profit and loss account. The explicit exclusion of dividend income from the BP is in line with section 56(2)(1), which provides that dividend income is taxable under the head income from other sources. It should be noted that where the dividend is received in respect of shares or security held in stock in trade, various courts have held that it should be treated as income arising from course of business, though for the purpose of chargeability, it is included under the head income from other sources. So basically, whatever the dividend income is, that has to be disclosed separately, and that separate disclosure has to be made in the schedule income under head other sources, and it shall not be credited back to the profit and loss account that is made under income from business and profession, that is schedule BP. Moving towards the next change, that is change in schedule 80 IA and IB due to sunset clause. Any assessee deriving profit from eligible business can claim a deduction under 80 IA or IB. Due to sunset date, the deduction under this section is not available for certain businesses like telecommunication, revival of power generating plant, cross-company gas distribution, multiplex theatres, etc. Schedule IA and IB have been amended to remove the rows allowing deduction under the above obsolete provisions. So there were heads that were available, but because the sunset or the exemption limit has moved off, so this particular schedule has been taken off from the new ITR return forms. Total secondary adjustment made to be disclosed. So this is again related to transfer pricing. Section 92 CE provides that an assessee shall be required to carry out secondary adjustment where the primary adjustment to transfer pricing has been made. If due to primary adjustment there is increase in total income or reduction in loss of the assessee, the excess money shall be deemed to be an advance made to associate enterprise, and the interest on such advance shall be computed. So we all made this particular secondary adjustment in the transfer pricing. Even in the previous return cycle, there has been no change with regard to this particular thing. Now, section 92 CE 2A also provides that where the excess money has not been repatriated, the assessee will have the option to pay additional income tax at the rate of 18% plus surcharge on such excess money or part thereof. The old ITR forms require the detail of such tax on secondary transfer, on this secondary adjustment. In the new ITR forms, there has been a separate schedule named TPSA provides that the assessee needs to indicate the total adjustment made in respect of all the assessment year. So again, a disclosure requirement, whatever the disclosure or the adjustments have been made, so they have to be disclosed for all the previous assessment years, basically. Section 43B also specified that certain expenditures are allowed as deduction only on actual payment, even if the assessee follows the mercantile system of accounting. However, these expenditures are allowed as deductions in the year of accrual if the payment thereof is made either in the previous year itself or in the subsequent year or before the due date specified in the filing of return of income. The Finance Act has amended 43B to include in its scope any sum such payable by the assessee as interest on any loan or advance from a deposit taking NBFC or systematically important non-deposit taking NBFC. So again, purely other information disclosure requirement, the new ITR form have inserted a new row in part A, OI, other information required the assessee to disclose the amount of interest on any loan or advance from a deposit taking NBFC or systematically important non-deposit taking NBFC, which was disallowed in the earlier year, but it is allowable in this particular financial year. Government is just asking us for as many as disclosures as they require for the purpose of making assessments and checking the genuinity of transactions, that whether we are doing or following the provisions in essence. So that is the primary thing that I noticed going through all these changes in particular. Again, we move to another disclosure that talks about separate disclosure of interest and dividend taxable under section 115 AC. Schedule special income seeks detail of income chargeable at tax at special rate. Earlier, this schedule required the combined disclosure of total income taxable under 115 BSE, that is income of a non-resident from bond or GDR purchased in foreign currency. Now, the new ITR form has amended schedule SI to seek separate disclosure of the following income taxable under section 115 AC, and that is income by way of interest received by non-resident from bond purchased in foreign currency, income by way of dividend received from GDR purchased in foreign currency. Further, a residuary clause has been also provided to report any other income that is taxable at a special rate. So basically, interest has been bifurcated, dividend has been bifurcated, and if there is any other income that has to be disclosed separately for a special rate, so that has to be reported separately for the non-residents. This is also again a disclosure requirement. Additional information from assessee not opting for presumptive tax. So this is important. This is important for all. Audit under section 44 AB is mandatory if the total sales turnover or gross received from the business during the previous year exceeds 1 crore. So this exemption limit was made 5 crores if the 95% of the business was non-cash. However, if the cash receipts and cash payments do not exceed 5%, the audit would be the audit limit. If the turnover of the business does not exceed 10 crore during the financial year, for the purpose of computing the limit of 5%, payment or receipt by a check drawn on a bank or by a bank draft, which is not an account pay, shall be deemed to be the payment or receipt in cash only. The old ITR forms required the assessee to furnish the response regarding cash receipts and payment only, and it did not consider the receipt or payment through non-account pay check or DD. So whenever we talk about an account pay check, so a check is always considered an instrument that we talk about to be one that is cashless. But however, there are account pay checks or demand drafts, so that can be bearer, and the money flow or the money supply would come in picture. So do we consider this particular amount to be something that is counted for checking the limit of 5% for the non-cash or the cash expenses? So the following additional disclosures are required regarding the audit information: whether total sale turnover or gross received is between 1 crore and 10 crore. If not, is it below rupees 1 crore or exceed 10 crore? The new ITR form require aggregation of receipts and payment in cash and non-account pay check or DD while computing the limit of 5% as mentioned above. So they have taken it to mean cash, and thereafter you have to compute this particular amount of 5% taking in consideration the non-account pay check. Now the question is that even somebody from the previous session has asked me how we would get to know that whether this particular amount or this particular 5% amount inclusion is made through a non-account pay check or a DD, because this particular thing has to be communicated from the client only. Otherwise, there is no other source to verify this particular thing in a sense. Even after evaluating the bank statement, I have checked that there are certain instances where a non-account pay check is written as MICR outward. So we are not able to trace basically whether it's a check payment or a non-account pay check payment. So there has to be a specific machinery, or there has to be a communication from bank also for this particular assertion, or we have to perfectly take a management representation letter on this particular ground that there has been no account pay, non-account pay check payment, or there is no demand draft, bearer demand draft payment that has been made by you. So otherwise, this particular assertion cannot be self-evaluated. I mean, there is no external confirmation that is available with respect to the same. Now we are moving to separate ITR changes. So that are changes that are particular to ITR 5. What are they? Reduction for capital gains under section 45(4) attributable to assets retained firm. The Finance Act has made partnership firm liable to pay tax on the business income of capital gain arising from transfer of assets to the partner on dissolution or reconstitution of the firm. The computation of income from such distribution shall be made as per section 9B and section 45(4). Section 48(3) allows an additional deduction for the capital gains charged to the tax under section 45(4), which is attributable to capital asset remaining with the firm. The CBDT has inserted Rule 8AB to prescribe the manner in which such attributable amount has to be computed. The new ITR 5 has been amended Schedule CG to disclose the deduction allowable under section 48(3) in respect of capital gains charged to tax under section 45(4), which is attributable to capital asset remaining with the firm. Again, purely a disclosure requirement. The schedule specifically contains this clause where the allowability under section 48(3) has to be reported in order to claim this particular deduction, and the assets that are retained by the firm and like on the dissolution or reconstitution of the firm. So this particular exemption has to be evaluated in as per the Rule 8AB that was already in place. Just the disclosure requirement has been added for claiming the deduction in ITR 5. Disclosure for new alternative tax regime opted under section 115 BAD. So we have for the individuals in BSE, for the cooperative societies in BAD. The following disclosures are required in ITR 5 in respect of alternate tax regime under section 115 BAD. And what will they be? The ones that we have already discussed, where a cooperative society has opted, it has to furnish in AY the form 10IF. 1F, IF. So for the previous one, the individual, we see that the form 10IE was in place. And here also, again, you have to mention the acknowledgement number. It would auto populate if you have filed it, and you have to give that particular details. Where a cooperative society is choosing to opt For an alternate tax regime, it has to furnish the date of filing of the Form 10IF with the acknowledgement number. These changes we have already discussed in the other ITR form. That is not much a big difference. Just that was in substance particular to ITR 5. So that I have included that in our discussion. Now we are moving to changes that are. Sure. I'll share up the PPT. Don't worry for this. Now we are moving to changes that are particular to ITR 3. We talk about ITR 3, that is Schedule 80 GGA for partners deriving profit, only profit from the firm. So here we see a condition that where a partner is just deriving profit from the firm, even that profit has to be disclosed under ITR 3. And why ITR 3? Why this provision is in particular important? Why Schedule 80 GGA is in place? So let us see. GGA of the Act allows deduction in respect of amount contributed to specified association or institution. This deduction is allowed to an assessee who is not having income taxable under the head profit and gains of business or profession. So if we see in this particular case, if he is deriving profit, that particular profit would flow into income from business and profession, and there that is why where he could not claim a deduction under 80 GGA. A Schedule 80 GGA, detail of donation for scientific research or rural development, has been inserted in ITR 3. This schedule is applicable in case of a partner of a firm deriving only profit from the firm. The following disclosures are required in this schedule if partner of a firm seeks to claim deduction under Section 80 GGA and he is not earning any business or professional income except the share of profit in that particular firm, which is exempt is in his hand, because already the LLP or the partnership firm or the LLP has paid tax on it. Relevant clause under which deduction is claimed: name and address of the donee, PAN of the donee, amount of donation in cash and in other mode, and eligible amount of donation. So these all disclosures have to be made in. Moving to the changes that are common to ITR 6, that is return for the company. So disclosure of interest income at concessional rate of 4% under Section 194 LC. So the 194 LC provides a specified company or a business to deduct tax at the rate of concessional rate of 5% from interest that is paid to non-residents. The tax is deducted at a concessional rate if the borrowing is made before 1st of July 2023. The Finance Act has reduced the rate of TDS to 4% in respect of interest payment to a non-resident against borrowing in foreign currency through issue of a long-term bond and rupee denominated bond, which are listed on a recognized stock exchange in any IFSC. Again, privilege we flow to the IFSCs, and that is why a TDS reduction of 1% has been extended here also. What is there? Again, the disclosure has to be made separately, whether the non-resident being paid the interest have to be like marked in separately, and whether it is given to the IFSC, that has to be separately announced, and whether it has to be paid other than IFSC, that has to be made. So the new ITR forms make the concessional changes in Schedule OS. A new row has been inserted to the schedule to disclose the interest referred to in Section 194 LC, which is taxable at the rate of 4%. Again, for the benefit of the government, the same disclosure has been added. Now coming to disclosure of income of FII, foreign institutional investor, and specified fund chargeable under Section 115AD. Section 115AD contains a special regime for taxation of FII and specified fund. It provides dividend or interest income earned by the FPI is chargeable at a concessional rate of 20%. Where interest income is received or receivable in respect of investment made by the FPI rupee dominated bond of an Indian company, government security or municipal debts securities as referred to in Section 194 LD, the tax shall be charged at a reduced rate of 5%. Again, benefits flowing up to specified funds and FIIs. In case of a specified fund, the dividend or interest income earned by the specified fund is chargeable at a tax at a concessional rate of 10% instead of 20%. The new ITR form has amended to incorporate the above changes introduced by Taxation and Other Law Amendment Act and the Finance Act 2020 in Schedule OS. No much of a change. Again, a disclosure requirement that has been added up. And I don't know how much other disclosure requirements are getting added up in the coming ITR return forms. We see another disclosure coming from units located in IFSC in Schedule MAT. Again, a disclosure. MAT is booked at 15%, but for units in IFSC, it is again 9%, just as we studied in for the AMT. So the Schedule MAT has been sought separate disclosure of computation of adjusted total income under Section 194 JB in respect of units located in other units, and now income of the units in IFSC shall be reported separately in the schedule MAT for computing the book profits and tax payable there. Again, the same change as we have read in schedule AMT under ITR 3 and 5. So that flows parallelly to ITR 6. Disclosure for alternative tax regime opted under section 115 BA, BAA, BAB. So this being particular to companies. Where the domestic company has opted in for alternate tax regime, it has to furnish in AY in which he has opted is exercised for the first time, and the date of filing form 10IB for this for the section BA, IC for BAA, and ID for section BAB with acknowledgement number. If the company is choosing to opt in, then they have to furnish the detail of filing of the relevant form IB, IC, ID with its acknowledgement number. The same change that we studied in ITR 5 for section 115 BA D. New schedule IF inserted to seek the disclosure of investment made in incorporated entity. The new ITR form 6 inserted a new schedule information regarding investment in unincorporated entities that requires the company to disclose the following information in respect of investment made in an unincorporated entity: the name of the entity, type of the entity, PAN of the entity, whether the entity is liable for audit, whether section 92E is applicable on the company's share in the profit of the entity, amount of share in the profit, and capital balance as on 31st March in that particular entity. So that is again a disclosure requirement that is particular to any reporting by the investment company made in any unincorporated entity. Moving next, we are moving to common changes that are to ITR 1 and 6. So we see the variance, basic return getting evaluated with company return, that is ITR 6, but the changes are common. What to do? Removal of reference of section 153A and C for ITR filed in response to a notice. As per old provisions, where the search is initiated under section 132 or books of account, other documents or assets are requisitioned under section 132A, and SSC was made in the case of the SSC or any other person under section 153A and C. The Finance Act has introduces a sunset clause, and accordingly the provision of section 153A and C were made inapplicable starting from 1st of April 2021. Where search is initiated or requisition is made on or after 1st of April 21, the assessments, reassessments, recomputations shall be made under section 147, and the notice for the same shall be issued under section 148. So basically 153A and C would automatically become redundant, and that is why the references has been removed from ITR 1 and ITR 6 respectively. Hence the SSC shall now file his return in response to a notice under section 148 in the new ITR forms. The new ITR would remove those particular check boxes for section 153A and 153C from the field of filing status of return income. So that was a change that was common to ITR 1 and 6. Now, moving towards last two limbs of our discussion, that is furnishing of return made mandatory. That is a new rule has came in, that is rule 12 AB. So we have seen in the past financial year, filing of returns have been made mandatory. A 7th proviso to section 139(1) was also introduced, which laid up 3 conditions where return filing was made mandatory. But now further conditions have been made by rule 12 AB, where in following cases, which we'll discuss in the next minute. So in that particular cases, the return filing would be mandatory for the particular SSC falling in that particular limit. Conditions for furnishing ITR by persons referred to in section 139(1)(b). The conditions for furnishing return of income in respect of person referred to in clause B of section 139(1) in terms of clause 4 of the 7th proviso to section 139(1) shall be the following, namely. So what was this clause 4th basically? So it said that any other condition that may be notified by the government in the coming time, and that is where this particular notification has been made under rule 12 AB. So if the total sales turnover gross receipt as the case may be in the business exceeds 60 lakh rupees during the previous financial year, in that particular case filing of ITR will be mandatory. If the gross receipts in profession exceed 10 lakh during the previous financial year, even then ITR filing would be mandatory. If the aggregate of TDS and TCS jointly at source during the previous year in the case of a person is 25,000 rupees or more, even in that case ITR filing would be mandatory. And the deposit in one or more saving bank account by a person in aggregate is rupees 50 lakh or more during the previous year. So in these particular cases, ITR filing would become mandatory following the Rule 12AB that has been introduced, provided that in case of an individual resident in India whose age is 60 years or more, so they have given a benefit to the senior citizens at any time during the relevant previous year, the provision of clause 3 shall have the meaning as 25,000, that is replaced by 50,000. The reason being the TDS and TCS limits followed on the senior citizen is that of not of 25,000, that is of 50,000. So that is why they have made a separate substitution for senior citizens. Moving towards the last limb of a discussion, that is updated return or ITRU, that is section 139(8)(a). So this is a newly introduced provision that is coming up for the first time in this particular financial year, and following which you can file up for the updated returns. We are not calling it revised returns, reason being we are already revising the returns under the section 139. But this is a newer provision that talks about updated return, where you could actually file for the returns that have in the past 24 months ending from the assessment year, that you have already filed or you have missed out filing. There are certain conditions attached to it. It is not purely what we see in a sense that you can now file your returns. Government has given you an extended term cycle to file those returns. So there are certain conditions that are in line. And what are these? We're going to study everything in detail. So any person, whether or not he has furnished a return of income for an assessment year, can file an updated ITR. Therefore, an individual firm, LLP, a company, OPBY, can file updated return of income. It's for every person. The specified trust institutions such as research association, college, university, medical association, securitization trust are also required to file return under section 139(4)(a) or under section 4D, and that is equated with the return under section 139(1), and therefore the updated returns provisions are also applicable on them, and they can also file up for the updated returns. The taxpayer can file off ITR updated ITR within 24 months from the end of the relevant AY. So for the assessment year AY 22-23, the taxpayer can file his updated return latest by 31st of March 2025. So that is where updated return of this particular, the financial year 21-22 can be filed, that is 24 months after the assessment year. And in this particular financial year, we can file the ITRs or update the ITRs for the previous two financial year, that is 2021 and 19-20. So they being the financial year where we can file up the updated returns for. An updated ITR can be filed whether the taxpayer has filed his original ITR within the extended time limit provided under 139 or not, that is the belated return. In case where the taxpayer has not filed ITR under section 139 in case of an updated ITR, it can be filed provided the updated ITR is not a loss return. So it has to never be a loss return, and that is why I was saying that it is not an extended time limit that the government has given you for filing the ITR forms. It is there, but just for the purpose of revenue collection, so that the revenue escapement is stopped. The updated ITR should not be in loss ITR, and second, the updated ITR should not result into a refund. So even for those persons who have missed out filing the ITR and unable to claim their TDS refunds, even they are not left from this cycle. If the taxpayer has filed ITR under section 139, that is original, belated or revised, then he can update the ITR provided the updated ITR is not a loss ITR. The updated ITR should not result into a decrease in original tax liability or increase the refund claim. So basically the government is just seeking for the tax, and it is neither giving you an option to file for your return in in the future period, or neither it is giving you an advantage to claim up any refund or to decrease your original tax liability. So that is a premise of updated return ITR-Q. Under the following circumstances, it is provided that the taxpayer is not eligible to file an updated ITR. What are they? If such is conducted under section 132 or any books of accounts as have been requisitioned under section 132A, and that has been initiated in case of any purpose. If there is any survey under section 133A, if there is any notice under section 153C of the IT has been issued in case of such person in consequence of any search or requisition initiated in case of a third party prior to 1st of April. Notice under section 148 of the IT has been issued in his case in consequence of a search. Again, so search and requisitions are the two conditions where the government is not allowing that particular SSC to file up for the updated ITR. In above cases, the taxpayer is not eligible to file an updated ITR for the block of 3 assessment year covered by the provision of section 148. That talks about the new regime. For the next 3 AYs, you cannot particularly file your updated ITR if you are falling under any of these particular 4 conditions that have been cited up. What are the other conditions? The taxpayer is not permitted to revise an updated ITR filed under section 139(8)(a). So once updated ITR updated return is filed, it's final. If any proceeding for assessment, reassessment and or revision is pending or same is completed under section 143(2) or 147 or 263 for any AY. If any of the following information is in the possession of the AY which is communicated to the taxpayer prior to filing an updated ITR. Smugglers and foreign exchange manipulators, Forfeiture of Property Act 1988, Prevention of Money Laundering Act, or Black Money, Undisclosed Foreign Income and Assets and Imposition of Tax 2050. Any information is received under section 9090A of Income Tax Act which is also communicated to the taxpayer prior to the filing of updated ITR. Last two conditions, if any prosecution proceeding has been initiated against such person under chapter 22 of the Income Tax Act and any other class of person that may be notified by the central government in future. Even after giving so much condition, the government has left scope that they can now also restrict few of the people in the coming time. They can restrict them of filing ITR. So on preliminary reading, one may get an impression that the provision provides one more opportunity to the taxpayer to claim belated relief. It is, however, not the case. The taxpayer is permitted to file an ITR 4 under selective circumstances. We have evaluated all. Is not permitted to lodge any claim or claim loss or excess refund or reduce the tax liability while filing the updated return. The provision, however, reduces the burden of the tax department in administering the cases involving potential tax escapement. So this particularly updated return has been given up to recover that tax revenue that has went in eventually from time starting from the 24 months of the assessment year. So that can be filed up, and that is where the government wants to earn back that revenue so that their administering costs should be reduced. But there are certain things that are to be observed in particular for these ITR-U forms. So let me give you an example or an illustration by which we can understand ITR-U better. So we take 5 cases. So in these 5 cases, first three cases talk about where ITR is filed under section 139. And in the 2 cases, otherwise 4 and 5, we talk about cases where ITR is not filed. So we say where ITR is filed, case number 1. So total income is 100 lakhs. Additional income, say suppose in the ITR-U that has to be updated up, that is 50. So the total income that becomes for filing of the updated ITR becomes 150. So I have taken for the purpose of easy calculation that the tax is even, that is 30% without any surcharge or cess. So tax payable on original ITR becomes 30 lakh, taking 100 into 30%, and tax payable on the updated ITR becomes 45 lakhs. So yes, there is a difference of 15 lakh that has to be paid in more. Whether taxpayer is eligible to file an updated ITR, so the answer goes yes. For other cases, we are talking about the case 2 and case 3. In the case 2, we see the total income is 40 lakh. The additional income is 50 lakh, and that is where revised total income becomes 10 lakh. So the tax payable on original ITR becomes 0. Tax payable in updated ITR, however, becomes 3. Whether taxpayer is eligible to file an updated ITR, the answer is again yes. In third case, we see the total income is 90 lakh, additional income is 50 lakh, and the revised total income goes on to a loss. So the tax payable on original ITR was nil. Tax payable in updated ITR becomes nil. And that is where the note comes in picture that we cannot file for this particular updated return form because the income exposure becomes negative. In case 4, we are filing for ITR that is not filed in case 4. So the total income is loss, additional income is 50. Revised income for the updated ITR goes on to 10. Tax payable was not applicable as it was a loss earlier. However, tax payable in the updated ITR is 3. Whether the taxpayer is eligible, again, the ITR-U can be filed. In the 5th circumstance, we take total income to be 90, additional income to be 50, revised total income under the provision to be 40. Tax payable on the original ITR become not applicable. Tax payable in the updated ITR again becomes nil because the total exposure is nil. And what will happen in this particular circumstance, stands a note that you cannot file up for the ITR-U. Now, my observations on this particular assertion is that in terms of section 139(8)(a), among the other things, the taxpayer is not eligible to file an updated loss return. Therefore, on bare reading of the provision in case 5 particularly, even if the taxpayer is offering additional income of 50 lakhs, the revised total income is still a loss. Thus, as per the literal interpretation of the provision of 139(a), the taxpayer is not eligible to update his loss ITR. In this case, the taxpayer is eligible to claim carry forward of a loss of 90 lakhs and additional income of 50 lakh remained escaped from the assessment because They have not considered that in the ITR 4, and that is where the carry forward can be claimed for 90 lakh. And that is where return of loss cannot be filed under the updated return. It would result in a revenue loss. The legislature should have never intended to exclude such a scenario from the operation of the new scheme. Therefore, the government should take appropriate amendment in proposed provision to clarify this particular stance. So this again remains a point of ambiguity. But however, we cannot, as of now, the rules that have been notified, we cannot file updated return even in case 5. That is where I guess just like 1 or 2 slides left, computation of tax payable. So if in case you are filing up for this particular ITRU, so if you are filing that within 12 months ending from the assessment year of which you are filing the return, so the additional tax that would be payable would be 25%. And if you are filing after 12 months but before 24 months, so the additional tax would tune up to 50%. So that is where you have to pay in for the additional tax, and you can claim the credits of everything that was in picture, like credit of TDS, advanced tax relief. So that is going to be available to you. It is clarified that ITR return can be treated as invalid if the taxpayer fails to pay additional tax along with the ITR, and once invalidated, it cannot be validated again. So computation of tax payable, as I already told you, so an additional fees under section 234F. So this applies even to the updated return. So if the taxpayer has filed his return, the initial return, normally in the normal circumstances, so in that case there would be no fee that would be payable for the updated ITR. But if that particular return is filed late, then that additional fees of 5,000 shall stand payable even for the updated return. So with that, I guess we cover all the provisions of whatever the changes were introduced by the new return forms. So here are my basic details. You can note them for future interaction. And let me just quickly show you like whatever the changes have been made in the return forms now. So whatever we have like discussed in detail. So let me show them to you quickly. So this is for the assessment year 22-23 if you see. And so first of all, you see that in this particular section, so there has been like pensioner, CG pensioner, SG pensioner, PSU pensioner, others. So there have been separate disclosures that have been made. 153C has been removed up. Here you can see that the acknowledgement number for BAC, if you are selecting yes or no, so that is in place. Again, 3 conditions that were there in schedule that are in place. So moreover, we have talked about a schedule 89A, if you can see, foreign tax retirement benefit account that we talked about. So that is in picture. Next, we are coming across the schedule other sources if it's there. Let me show you that in ITR, the other ITR form, the ITR 2. So let me show you first the residential provisions that we talked about, that what are they. See, for the resident, there are disclosures that are flowing in, resident but not ordinarily resident. So this condition has been added up. Earlier it was not in place. Non-resident, you have to give a full disclosure, that was in place even earlier. Okay, next let me show you the capital gain table. So if we see, so in capital gains, so bifurcation is there, the PIN code is there in place, zip code has been added up, the multiple cost of acquisition without indexation, with indexation, year-wise disclosure has been ended up. And let me show you one thing for dividend also. So see, dividend income other than 2 and dividend under 222. So these are all changes that we like just discussed about in detail, and that is where I end up the discussion from my side. So you can take over and let me know if there are any questions that you face or come across while filing in for the return forms, and we'll jointly solve them up all. However, if we'll go through this presentation in detail, we have not left even a single point that has been added up from the previous return cycle to this return cycle. You can evaluate it completely, see the newer return forms. If there are any changes that you see are newer, you can even make me aware of it. However, my team has really worked hard upon it to find each and every change and brought to my notice. And that is where we have prepared this presentation with great effort. So thank you so much, everybody. And over to you, sir.
Ujjwal, very nice presentation. I know this topic is very technical thing, as soon as the forms have come, you've taken all the differences.
Correct,
So
correct.
detailed presentation here. I will take up any questions are there, we'll check up. I don't think in the with chat section is only we are more concerned about the PPT.
The PPT, right. The PPT is where the extra effort has gone in, and we'll definitely share up that PPT with everybody, not a problem.
We'll share it in all we have around 6 groups of WhatsApp. We'll share in those groups.
Sure,
So,
sure, definitely.
any other questions, members, they can post it in the chat box or inside the market. They can unmute themselves and ask the question.
Hello, Ujjwal sir. One question for me.
Yes, please.
See, can we file this updated return even if the return is not filed
Correct.
earlier?
Correct. It can be done.
It can be done. So for the
Yes.
assessment in 1920, now we can file a return of it.
Correct. So whenever you'll be filing up for the return for this previous financial year that ended on 31st of March 2022. So along with that, you can file this ITRU, that is the updated return, like making all the disclosures and details that are pertinent to the financial year, either 1920 or 2021. So that would go along with this particular year's financial, the previous year's ITR. So that can be made.
But we will have to pay 5,000 rupees as additional fees for that, right?
That can
Absolutely.
be paid.
That is payable, but you see that you are getting an option to file a return basically
Yeah,
even
we
after.
are getting.
Correct. So
Belated
that
time extra almost in one way.
we cannot escape that particular thing. Even in cases where you are updating a previously filed return, and if that particular return was filed late, even in that case, even for the updated return, you have to pay a penalty of 5,000. That is also there in place. However, if you have filed ITR, the ITR of the previous year under 139(1) well in time, then there is no tax, no late fees that flows on to ITRU or the updated ITR. So 5,000 being the additional fine for your non-filing or late filing, whatever it be.
One more question.
Yes,
Sir, one
yes,
thing.
yes.
See, if we opt for the alternate taxation under Section 115 BSC, even this year are we required to file Form 10 IE or not?
So basically, if you have already opted in for this particular financial year, so 10IE is basically an every year compliance. So you are required to file 10IE every time whenever you are opting in for this particular tax regime. Whenever you will select, if you are in the previous year selected Form 10IE, so the 10I auto population code would automatically switch into your return form this time with the acknowledgement number. Okay. For this particular financial year, when you will select continue to opt. So there is an option this time to continue to opt, and you will select that particular option and you will follow, the return would automatically get submitted following that particular 10IE code. So there is no problem.
In principle, we have to file the 10 IE also.
Yes, that is there. Why the government is asking for 10IE once, I mean, why they are fixing up that acknowledgement code in the previous one is in that particular case, that whether that person has filed that 10IE for the previous year or not. If you have not filed, I mean, the government is not even giving you the benefit to take or opt in for the 115 BSC this time. So that is why they have opted in or made a separate disclosure box in this ITR form to you for you to have selected that you have filed in for IE previous year or not. So that is the purpose.
Okay, thank you.
Okay. I get a question, can updated return be filed if income below the taxable limit? Then what will be taxable liability? So if we see a case here, so there are two conditions that they have outlined, like they have moved it out of the ambit. One is loss return, and the second is where you are claiming a refund. So in this particular case, if you are instilling to file a return that is under the limit of say suppose 2.5 lakh or 5 lakh, whatever is applicable to you, in that case you will have to pay government the late fees of not filing your return well in time. So in that case 5,000 would stand payable. So the government is basically earning this particular revenue out of you. So, and that was the sheer purpose of bringing in ITRU, so that even from places they cannot earn anything, they can get at least the late fees. And even in cases where the assessment was escaping the tax liability, in that particular case, they'll get up the refund and reduce their administering cost for tax escapement. So that is the entire purpose of ITRU. Now, what as an individual or a client, we suggest our clients to be, so for the clients who are looking out for taking up loans and they have not filed up their returns for the previous year or be their second or first year for this particular return cycle. So at a just cost of 5,000 rupees, mere 5,000 rupees, they can get their loans in place by filing a 3-year return in place just by standing in this particular financial year. So that is where this thing is good for all of them. But if you're talking it otherwise, it is good for the government for earning revenue. So that is where things are always in place for the side of the government itself. Any other questions if anybody has?
One more question, sir. Sir,
Yes,
this deemed income under section 222E, it is a separate disclosure is required in this year.
Correct.
So usually the only disclosure for the sake of disclosure we will show it in that, and it is charged under income from other sources as usual.
Yes, absolutely right.
That's it. Okay, thank you. Right.
That is just for the purpose of creating a segregation, because what will happen is, and if we talk about the dividend thing, this time we'll get in picture the AIF, that is the annual information statement, and with that AIS, your dividends that are paid by the public limited companies, that would get populated there. And when you'll enter an entire dividend there, it would not match up and there would be inconsistency flowing in. So that is where for that particular purpose, they have segregated or bifurcated the dividend into two, so that the matching concept can be followed in line with the AIS and 26 AIS. So that is where the sheer purpose of making that bifurcation is. As and far they are increasing those disclosures, they have to see or make in pictures that the assessees or the clients do not get auto-populated messages from the compliance portal or the e-governance portal. So that is also where they have to fix things in, because otherwise disclosures would be like hundreds or thousands and it would create a mess. Everybody would be like, we'll not disclose anything from the next year. So that is where the separate disclosures are getting in place.
Okay, thank you, sir. Right.
Hello.
Yes,
Hello.
I can hear you.
Sir, I'm Hanuman speaking, sir.
Yes, please.
There are AIS information is coming, but 14820 notice is not received. Whether they can file ITRU?
Yes, definitely.
In previous years.
Yes. So first of all, if you are talking about AIS came for the very first time for the previous financial year, and even the government made it very clear with regard to the AIS that they are not going to see AIS for the previous financial year. It is starting with this particular financial year, that is 21-22, that they'll be actually creating a reco or the reconciliation of the data with the AIS for the purpose of issuing of notice. So if any of your particular client, their data is not matching up with AIS, or the actual data reported is greater or higher than the AIS reported information, then you can definitely file ITRU based on that particular criteria. However, if there is a circumstance where the information that is reported in AIS is higher and whatever you are going to report under ITRU is lesser, even you can do that. You will not get a notice for sure under the guidelines that is concerned with the AIS matching. However, you have to ensure that your compliance with regard to Form 26 AIS is in line. Otherwise, you can get a notice for sure. So you have to evaluate the situation as per your client's requirement and then choose to file up ITRU or ITR or otherwise.
What I meant to say is AIS information is correct. The client wants to update, file his return. Whether he can do that?
Yes, he can do that. I got your question now. So you are saying basically, if in the AIS of the previous year, the information has been updated and the client has made a lesser disclosure, like that is not matching up with that particular AIS in the previous financial year, can he now update the information in the ITRU? So ITRU is for the same purpose only. The only two conditions where it cannot be filed is whether you are claiming a loss or you're claiming a refund. So if it is not causing these two situations, like of increasing the refund liability or decreasing the total taxpayer liability, you can definitely file ITRU, and it is good to revise the return in time if it is not matching. Otherwise, even in future also you can be liable to get a notice. So you can very much file ITRU this time.
If you want to claim refund under one, it should be go for 192B.
No,
Okay,
no.
to claim refund.
So refund is not available as an option under section in this particular return ITRU.
ITRU is not available.
It is not available.
But what is the other alternative 192B? Have to apply to the commissioner to condone the delay.
Okay, so that is where if you can approach your the assessing officer in person, you can land up with all the entire computations that you wish to manually apply for getting the return revised. The assessing officer will evaluate the case, and if he is convinced enough, he'll consider the case for revision, and this entire process would be based on his decision. He will issue a notice for that particular respect, and in that particular case only you will be able to file a continuation return under section 192. Otherwise it is not possible. So you have to approach the AO. AO would issue the notice. Based on that notice number, you will be able to update the returns or claim a refund. But under the ITRU or self-populated automatic requirement, you cannot do that.
It is not possible. It is not possible. Thank you. Thank you.
Okay, most welcome.
ITRU is yet not updated in the portal, right?
Right. It is not currently updated, but as soon as we'll start filing, I mean starting June, there I heard, and however there is no official requirement for now, but as soon, I guess, in a shorter span of say suppose 10 or 15 days, we'll be able to see ITRU this time for sure.
Oh.
Yeah. For now, it is not showing up definitely in the system.
Yeah.
Usually, I think we have no more questions, and such a detailed presentation, sir, exhaustive and very detailedly explained. And we thank on behalf of the Telangana and Andhra Pradesh Tax Bar Association. And now I request for a formal vote of thanks, our GC member, Advocate Amna.
Good evening. I would like to express my gratitude to all esteemed delegates of the webinar for their presence and contribution to make this webinar a great success. I extend my gratitude to Honorable Speaker, Mr. Ujjwal Jindal, to take out time for his busy schedule to grace the event and give valuable subject to tax practitioners. Thank you, our President, Mr. Ritesh Mittal, and Secretary T.N. Reddy and other members for providing immense support to make the webinar success. Thank you very much. Thank you.
Thank you, everyone. Thank you, sir. Thank you, Ujjwal.
Okay. Thank you so much, everybody, for attending the session. And it was once again a pleasure being associated with Tax Bar Association. Oh, I'm missing Ramdev ji here because like he invited me also to the event, and he is a member who is always present for such events. But that's okay. So looking forward to next session on a distinguished topic like this. And thank you so much for inviting me and listening to me. Thank you so much.
Thank you, sir. Thank you.
Thank you.
So thank you one and all who are present there, sir. Thank you very much.
Thank you.
Thank you, sir. Thank you, Ritesh. Thank you, T.N. Reddy garu.
Thank you, sir.
Thank you, sir. Thank you.